6, 5, 4, 3, 2, 1, 0.
Welcome back to Beyond the Ledger, where we look past the numbers to uncover the strategies, risks, and opportunities shaping today's businesses. I'm your host, Shardae Layfield, and each episode we bring you insights from the experts helping companies navigate complex financial decisions and maximize value. Today we're exploring an area that every property owner, commercial or residential, should understand: tax incentives for real estate owners. From energy efficiency credits and cost segregation to R&D and Section 174 implications, we're breaking down the opportunities that can deliver meaningful savings and fuel reinvestment. Joining me for today's conversation are two leaders from Bennett Thrasher's Tax Credits and Incentives practice, Nina Desai and Duwayne Sibley. Nina Desai is a partner at Bennett Thrasher, where she leads strategic initiatives within the firm's credits and incentives practice. As a licensed attorney and possesses deep expertise in R&D tax credits, Section 174 compliance, and startup tax strategy, Nina advises clients across construction, healthcare, manufacturing, distribution, and technology on how to translate complex legislation into business advantage. And Duwayne Sibley is a cost segregation director at Bennett Thrasher, who brings nearly 2 decades of experience helping clients uncover savings through depreciation strategies, fixed asset studies, and energy efficiency programs like 179D and 45L. Throughout his career, Duwayne has led projects across diverse industries, including multifamily residential developments, banking and financial services, retail and restaurant operations, manufacturing facilities, and much more. Together, we'll discuss what incentives are available for owners of commercial and residential real estate, how legislation such as the One Big Beautiful Bill Act is shaping the current landscape, how common misconceptions around deductions and depreciation, and how property owners can position themselves to capture every available credit and incentive. Whether you manage a portfolio, develop properties, or oversee financial strategy, this episode will help you understand how the tax code can work for you, not against you. All right, thank you both for being here today. Ready to get into some questions?
Thank you, Shardae.
All
We
right.
appreciate being here.
Thank you. So historically, what tax incentives are available to those in technology and manufacturing?
Yeah, Duwayne, I'll go ahead and take that. So it's one that you oftentimes don't think about, but the research and development tax credit is a very popular credit for companies that are involved in technology and manufacturing. It's a credit that allows you to offset some of that research and development effort that you are incurring. And so there are federal level incentives, and about 40 of the 50 states have a state level incentive as well. So it's certainly worth exploring and reviewing to see whether you're eligible for the credit and whether you qualify if you haven't done so in the past. And as I'm sure you're aware, I tell all my clients is that if you are engaging in R&D effort, you are already doing the work, you're already spending the money, you should at least recoup some of that credit that is available that the government has provided.
Nice. So that's a great overview of incentives historically. But when we talk specifically about R&D, what types of activities typically qualify for the R&D tax credit? And what are some common misconceptions?
Yeah, so I would say for an activity perspective, if you are developing a product, a process, a software, a technique, or formula, any of those activities could potentially qualify for the credit. The credit isn't necessarily available to specific industries. It is industry agnostic, but there tend to be industries that are more likely to be eligible for the credit. So your technology, manufacturing, your pharmaceuticals, even food science. I always say that's fun. Think about your clients that are developing wine or breweries or, actually developing a product. And we're trying to think about, shelf life and things like that, that it can really go as far as that. But I will say before I, started working in this space, when I used to think of R&D, I used to think of people that are, or in order to be eligible for R&D, I used to think that you have to be wearing a white lab coat, blowing things up in a lab. And it is so much more expansive than that. I mean, most of the clients that I work with tend to be technology and manufacturing. So these are your developers, your engineers. And so a lot of times too, I will say people often think that in order to be eligible for the credit, you have to be a very large company. Maybe you need to be a Google or an Apple, and that's not true. The credit isn't defined, or there isn't a requirement that you have to be a specific size company. It really is available to companies of all sizes. And I always say that I actually really enjoy working with my startup companies and watching them grow and helping them, evolve and seeing how their R&D changes and evolves with time. So that's another misconception, is size, industry. And I think another large one is that, well, I'm not profitable, so that I can't necessarily take advantage of the credit. And that's not necessarily true, right? So companies, depending on their revenue, they can potentially utilize the credit to offset payroll withholding taxes. So there are two ways. Let me just kind of back up there. There are two ways to utilize the credit. One is to offset income taxes, and two is to offset payroll withholding taxes if you are considered a startup. So that means your gross receipts are less than 5 million and you've only had gross receipts for 5 years or less. So that's something to certainly take a look at. And that's on the federal side. And of course, as I mentioned, about 40 of the 50 states have some sort of state level incentive. And other states might also have a similar type of program. I will say, like the Bennett Thrasher, we're headquartered in Georgia. So a lot of our clients are Georgia as well, or Georgia based. And so Georgia also offers a state level incentive where you can utilize your Georgia credit against payroll withholding taxes. And that's available to you regardless of what size company you are. You could be a startup, you could have been established for 10, 20, 30 years. So long as you are engaged in that R&D type activity and you're eligible for a credit, that's also an option to claim the credit. So I know I've said a lot, Shardae. Any questions on any of that?
No, I mean, I feel like that was great, and you've covered quite a bit, so it gives people a little bit more scope on like who can actually like take advantage of these. So it helps a lot. But let's dive into a little bit more.
That withholding option, I think, is
Yes.
a big deal. Like, I think people don't really think of that, and the fact that you don't necessarily have to have that income and you can use it against that in certain instances.
Yeah, I would say that's a really huge win. And also just making sure we're strategically thinking about it, because if you are going to use the federal credit against withholding, you technically can only make that election 5 times. So let's say you have really minimal credits that first year. Do you want to make that election that year, or do you think it's worth waiting for the second year? So there's a lot of planning and strategy involved in that as well.
Good to know. Thank you.
Of
Okay.
course.
So for companies already claiming that credit, how has the recent treatment of Section 174 expenses impacted companies claiming the R&D credit?
Yeah, that's a really good question. So it might be helpful if I kind of give a little bit of legislative background.
Of
So
course.
prior to the 2022 tax year, all companies that were engaged in R&D could immediately deduct those R&D expenses. So think you have employee wages, you could deduct that. Beginning in 2022 tax year, as part of the Tax Cuts and Jobs Act, all companies that were involved in R&D were required to capitalize and amortize those R&D or R&E expenses over 5 years if you have domestic expenses, or 15 years if you have international expenses. So if you're thinking about it, all your clients that are claiming, or all companies that are claiming an R&D tax credit, by default, they have these Section 174 expenses as well. So any expenses that are incidental to R&D are technically 174 expenses. So it kind of, in one sense, you were getting a credit for it, but for these expenses, but you weren't able to fully deduct those expenses. So it was actually increasing taxable income for a lot of our clients. So it was kind of a disincentive to do R&D to a certain extent. So we've been waiting for a fix for a while, because, right, I think we can all agree that this goes against all public policy about trying to spur innovation in the country, which is why the credit was enacted in the first place. So we've been waiting for a change, waiting for a fix, and then as part of the One Big Beautiful Bill Act that was recently passed on July 4th of 2025, we did get that fix. So now for companies in 2025, all your R&E expenses can be immediately deducted for domestic expenses. Now your international expenses will continue to be capitalized and amortized over 15 years, but at least you're kind of going back to the prior treatment that you had. So I guess to answer your question, then, it actually just makes the R&D tax credit a lot more lucrative. So going back to the old way where you can fully deduct those R&D expenses, but you can also claim a credit on it. Of course, there are some nuances there too, but I'll spare you all the geeky detail for now, but hopefully that kind of helps answer your question there. It makes the credit very lucrative. And I do think a lot of clients, when you're explaining the change for 174, they have this misconception. Well, I'm not claiming this R&D tax credit, so does that even mean I even need to include my 174 expenses on the tax return? And the answer is yes. These 174 changes are a compliance requirement, and the R&D tax credit was optional. You don't necessarily have to claim the credit. It would be nice to claim the credit. So just all of our clients that are engaged in R&D, especially software development, certainly want to make sure that they're aware of this.
Nice. Thank you. Okay, Nina, to wrap up the change to 174, were there any transitional guidance given?
Yeah, Shardae, I'm really glad that you're asking about this. So I want to start off with that if you are, affected by 174, this is a time that we would advise that you speak with your CPA or tax advisor to model out what would work best for you. But essentially, companies of all sizes can elect to take their unamortized expenses. They can choose to deduct them in either 1 year, beginning in 2025, or over 2 years between 2025 and 2026. So this is a time where you're going to want to model out which impact you should, or which method you should do. And as well, you can also, the trail of unamortized expenses, you can still follow that 5 or 15-year schedule, but it might make more sense if you're expecting a lot of income in 1 year to maybe flush it all out in 1 year or over 2 years. So you certainly are going to want to model that out. Also, if you're considered an eligible small business, that means you have less than $31 million in gross receipts and that you're not a tax shelter, you can actually go back and amend your prior year tax returns to immediately deduct those 174 expenses. So that's also an option for clients that are impacted. But I will say that you only have until July 6th of 2026 to file those amended tax returns, and you want to follow the statute of limitations. So for your 2022 tax return, if you filed on time, you are getting very close. So certainly speak to your tax advisor and see if that's something that you should be taking advantage of or looking out for. But those are some of the highlights. There's a little bit more nuances there, but I think for today, I'll stop there.
Well, thank you for the extra insight. Okay.
Of course.
So that's been a big adjustment for a lot of taxpayers beyond 174. Have there been any other notable updates or changes to the R&D credit itself?
Yeah, so the R&D credit itself, I would say, hasn't really changed, but
Okay.
I will say, of course, except for the fact that now your expenses have to be 174 expenses, but I will say the R&D forms have changed in the last year. So
Okay.
before there used to be like a one-page form. You used to list like your qualified expenses and how you calculated the credit. And in 2024, they actually rolled out new forms, which actually require that you list additional information. So you have to list out your business components, what's eligible. You have to tie out which level of your expenses are directly engaged to R&D, which are directly or related to direct supervision or direct support. And then you also have to list out the number of projects that you have related to R&D, whether your entity had an acquisition or disposition. And there are a number of additional requirements. And I think that's just part of the IRS's way or the government's way to ensure that the R&D credits that have been claimed are truly viable or truly real, good candidates for the credit. Because I'm sure there's always a little bit of concern that maybe there are some players or bad actors out there. So this additional requirement, this form has been revamped, and it was supposed to be, all that additional information was required to be listed in 2025 tax year's return, but they've actually pushed that back 1 more year because they've been getting a lot of feedback that it's a really onerous requirement. And that also, if you're going to now expect this, we need some more detailed instructions on really what are you looking for. So taxpayers do have a little bit of reprieve for a year, but here at Bennett Thrasher, we're trying to get our clients ready for the new forms and the new requirements by already having them go ahead and start thinking about, need to start tying this information together. And I think any R&D tax credit practitioner is already gathering this information as part of their study, but maybe not so much for the tax return filing. It's a lot to kind of gather a lot of information for someone who's filing in March or April, right, when you start the study in January. So it's just a little bit of a shift in, I think, our mentality about how we are going to conduct studies and getting our clients ready for making sure that they have the proper documentation to, substantiate their credits.
Thank you for the insight. Okay.
Of course. Thank you. Great questions.
Of course. Okay. Let's shift gears a bit outside of R&D. And many owners also look to leverage incentives through real estate. Historically, what tax incentives are available to those who own real estate?
Yeah, so we've got people that are either investing in real estate or potentially buying real estate for their own business, right? And so the first thing that comes to mind is cost segregation. So what that is, it's an IRS recognized strategy for identifying assets that can be depreciated faster. So specifically, a building is either depreciated over 39 or 27 and a half years. And a cost segregation study goes in and pulls out pieces of personal property and land improvements, things like that, that can be depreciated faster. And so what does that mean? You're not taking more depreciation, you're just taking it sooner. So that time value of money then allows you to pay less on your taxes because you've got this higher depreciation expense in those earlier years, and then you're able to use that money elsewhere for investment. So that's kind of a number one. And there's pieces that you can kind of couple into that, like bonus depreciation. When we identify assets that are less than or 20 years or less, then they get bonus depreciation for whatever the applicable amount is for that year. It identifies assets that potentially might qualify for 179 expense. And then kind of second to that then, especially on new construction, when we start looking at those plans for a cost segregation study, oftentimes you'll see that, hey, this is built like pretty energy efficient. And so since 2006, we've had, and it's been extended a few times and then made permanent, and it's actually has a sunset that I'll talk about in a second. But 179D is a deduction for commercial energy efficient construction. And so we're really successful in finding commercial buildings in new construction that we can then add that piece on and they can get that additional deduction. The 45L is kind of the counterpart part to that, but it's a credit instead of a deduction, and it's for residential construction. So it could be apartment complexes, it could be single family homes, places like that. The only thing is in the One Big Beautiful Bill Act, it did get canceled, which is kind of sad because actually in 2020, 179D until then had kind of been on extension and it was made permanent. And so we have a sunset for that right now, but it's fairly reasonable, and I think it really just creates a little bit of sense of urgency because if you've started construction by June 30th of 2026, you can still take that 179D deduction. And then for 45L, as long as the home is sold, or when we're talking apartments and things, leased by that same date, June 30th of 2026, then that credit is still available. So there's a little bit of room there for some planning strategy leading up to that date. So, when we're talking about real estate, we've talked about like when you buy something or when you construct something with the cost seg and the energy incentives, but then what about, over the life of the property? And so cost segregation studies, since the tangible property regs came out in 2014, kind of identifying systems that you can use to compare to for deciding if something can be expensed as repair and maintenance rather than capitalized. That really has brought in this piece to cost seg where we're identifying these systems and everything through the cost seg study, so that then over time, it's more like a lifetime study. You've got that detail to then be able to figure out what you could be expensing versus capitalizing that. So those are kind of like the high points, and like I said, you kind of have to look at it as a life cycle from beginning to end, and what are those incentives.
Okay. So, and with the new legislation like the One Big Beautiful Bill Act, how are those real estate incentives evolving?
Yeah, so it's interesting how over the past few years, like just new stuff that has come out has really almost changed the essence of a cost seg, right? So originally it was just like, hey, I'm trying to shorten the lives, right? But 100% bonus has come back with the One Big Beautiful Bill Act. And so I'll just kind of go into bonus real quick. So bonus depreciation started after 9/11. So after 9/11, it was such a shock on the economy that they were, the government was like, what can we do to spark investment and get things going? And so they came up with bonus depreciation. And so what that says is in that first year that you own the property, whatever that bonus rate is, you're able to write off that percentage, and then the balance is then depreciated over that shorter life that we talked about. And so, originally it was 50%, and this has gone on since 2001. And people kind of got addicted to it. So it wasn't just that short term. It was kind of over the years. it had kind of fluctuated between 50%, 30%. Most recently we were on a phase out where the 100% bonus ended in 2022 that we had. It was phasing down to 80%, then 60%, and 2025 was supposed to be 40%. And so One Big Beautiful Bill Act made the 100% permanent, right? So I think that makes it easier for planning purposes that we don't, know whether it's not going to be there or something like that. But at the same time, with different administrations and stuff, we saw with the 179D and the 45L, that was made permanent, but then it was pulled back. So, but for now, we do have the 100% bonus depreciation, which means that anything we identify in those cost segs that's 20 years or less, they are able to write that off in the first year. So as a depreciation expense. We also have 179. So Section 179 over the years has been popular, especially for smaller taxpayers. And so it allows people to expense personal property up to a certain amount. And so that was increased to 2.5 million. It does have a phase out starting at 4 million. So if you buy eligible property up to 4 million, then for every dollar over that, that 2.5 will go down until it's completely phased out. So that's why I say there is some limitations there. And that actually gets looked at the final taxpayer level. So, you're looking at maybe an investor that has K1s and different investments coming in, and they have to look at that limitation at that level. But it is pretty high right now. And so the nice part of 179, because some people are like, what's the difference between 100% bonus and 179, right? So 100% bonus is based on life, so 20 years or less. So land improvements, things like that qualify. But for 179, it really is only tangible property, except for some specific areas of real property. So that's called qualified real property. And so that includes roofs and air conditioners and things like that. So there are some opportunities to expense things beyond just that personal property with 179. One Big Beautiful Bill Act also brought out a new classification of property called qualified production property. And so that one, you'll almost see, I think of it in this administration really wants to promote incentives for manufacturing, where maybe before we had incentives for energy, right? So it's a trade-off there where I think that money kind of moved over. So qualified production property, you can think of manufacturing as what you would think of mostly on that. If they have real property that's related to just kind of give you the specific definition, but it involves manufacturing, production, or refining of tangible property that results in substantial transformation. So if you're doing that, then the property that's related to that will qualify for 100% bonus depreciation. And that goes into portions of a building even. So if I'm creating a production line and I'm building a building for that, it would potentially qualify. There are some caveats to that though, because it doesn't include areas like offices, administration, warehousing, things like that. So it does get a little complicated and it does require a study. We're definitely waiting on some future guidance from the government to let us know what the proper methods are for that. At this point, I feel like our cost segregation is probably the route to go into to actually divide those pieces up. Okay, and then One Big Beautiful Act, also the energy incentive phase out. That was the large ticket from that related to real estate.
Thank you for the insights. Okay, so that's helpful context. But one question we hear often from clients ties right into this. Can you really write off an entire manufacturing building?
Yeah, when that qualified production property first came out, I was getting kind of crazy questions, because it was interesting how there was an article out there and people would Google and say okay, now I'm taking this for, this is the rule now or something. And I'm like, no. Go back and look at the legislation.
Wait.
Yeah, because I think one of the things I had heard was, oh, my next code on my tax return is a manufacturing code, so now I can expense everything with my buildings, you know? And I was like, no, 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 it doesn't say that. It says, you know, qualified production activities. So when you think about manufacturing, like what all does a manufacturing company have? You know, they have an HR department, they have like a shipping department, they might have research and development, you know, people was talking about it, you know, testing new products and things like that. And none of those areas of the building qualify for that 100% bonus depreciation. It is only the areas related to qualified production.
Okay. Thank
Green,
you.
thank you for highlighting that because I do feel like when the bill first was signed, people really were asking some questions, but there was also a lot of misinformation out there. There were articles that were like, you can write off the entire thing, but there are a lot of caveats. There's, you know, to Duwayne's point, there's a lot of guidance that we still need about even certain definitions, like what does substantial transformation truly mean? And just there's a lot of vague terms, but obviously with the historical legislation, we do obviously have an idea of which direction to go in, but I think we'll be looking for that and looking out for some more information.
Yeah, and when we're talking, Nina and I have talked about this quite a bit. Like when you're talking uh, manufacturers that own their own building, right? It's very common for people to own their real estate in a separate entity. You know, first for like liability issues, but also like they may get to a point where maybe they want to sell and lease back the building or something. So it kind of gives them that flexibility. And right now, the rules say that the owner, like a lessor and a lessee, like that does not transfer over with the activity. So if the lessee was performing manufacturing, that's not available to the lessor. And so definitely with that additional guidance coming out about how to do the split and all of that, I would hope to see something out related to owner occupied, you know, where they're the same party on both sides.
That's a great point because we've been getting a lot of questions about that. And a lot of our clients do have it in another entity, but they're related parties. So we're hoping that the answer will be it's fine, but we won't know until we get that guidance.
Yeah.
Yeah.
Okay. And energy efficiency has been a big part of the conversation too. So some people think that programs were scrapped. What's the real story on 179D and 45L?
You know, I'm going to probably talk about 45L a little bit negatively, but the Inflation Reduction Act that came out for that, it it made 45L kind of piggyback off of Energy Star, so you had to be Energy Star certified to qualify for 45L. And there really wasn't a transition period, and there's planning that takes place, you know, planning up to being Energy Star certified and then getting that credit. So I almost feel like for 45L, we've kind of had a couple of years where it was not really as popular as it had been just because the rules had changed so much on that. So the cancellation on that, you know, it doesn't feel as hard, I guess you could say, but definitely there were people that still qualified, especially people that were already doing Energy Star, and then the amounts for single family versus multifamily were higher because you didn't have an additional prevailing wage requirement. And so the 45L, I would say, has drifted off a little bit, but definitely it is canceled for sales or leases after June 30th, 2026. So unless something else comes through Congress, that is the current phase out date. The 179D, that was disappointing because I do feel like there was a lot going on with that, and it did have a good transition period with the Inflation Reduction Act when it was changed up a little bit. The end date on that, new constructions, you know, it has to start construction by June 30th of 2026. If you look at larger projects that take a year plus to build, you know, if they're not starting until June 30th, 2026, maybe they complete in 2027, even as late as 2028, we're still going to be putting those deductions on tax returns for a few more years. So.
Dina, did you have anything?
Yeah, I was just going to add on the 45L. I mean, it seems like, to your point with the new requirement, there were very few clients that were able to take advantage of it because you really had to get in there and get certified pre-drywall and be involved with the planning process to ensure that they were eligible for the credit. But please feel free to correct me if I'm wrong there.
Yeah, I mean, it takes some planning to get to that, and they did not really offer a transition period to that on that at the time. On 179D, their transition period for their rule changes, they did give an allowance for that, but 45L, it was kind of like, I guess you should have had a crystal ball and known that you needed to do Energy Star to be able to qualify for credit, because it almost, I would say, like skipped a year of credit for a lot of people that used to qualify for that.
So, if energy deductions are still available, that raises another strategy question. With bonus depreciation still around, why wouldn't a company just capitalize everything and take the bonus?
So I will say, we talked about the maintenance regs, so I'll kind of say the official thing. So the tangible property regulations, those were effective for years beginning in 2014. And like I said, they basically define the rules for what you can expense versus capitalize, right? And so those were years we didn't have the bonus. So everyone was learning those, and they're fairly complicated rules, right? But they're fairly taxpayer friendly at the same time, where a lot of times you can get to the answer where something should be expensed versus capitalized. And so then in 2017, 100% bonus came out, right? And so at that point, you saw a lot of people kind of saying like, these rules are complicated, rather than me figure out if I should expense it and me feeling worried if I should expense it or not, let me just go ahead and capitalize it, right? Well, so what that does then is these shorter life kind of programs, so 100% bonus, 179, those kind of things, when you go to sell that property, there's a thing called 1245 recapture, right? So that means that that portion of the gain that you took as that special deduction, you actually have to, that portion of the gain has to be taxed at ordinary rates rather than capital gain rates. So you're basically creating more basis by capitalizing that then has this recapture rate to it, right? And so it always is a better answer that if you can expense it versus capitalize it, because you don't have that. Then on top of that, we've got certain states, like we'll take California for instance. That's a 13% state income tax rate, and they decouple from bonus. So like when you file your California return, you're not getting the bonus depreciation, right? But if you would have expensed it, it would have been expensed. Whereas capitalizing it, then you're not getting that deduction that you would have gotten at the federal level. So we've got state issues and we've got recapture issues, which generally make it better if you can expense something rather than capitalize it.
Well, thank you both for being here. Nina, Duwayne, this was a phenomenal conversation, and I know our audience will definitely grab a lot of things that help them in their day-to-day business strategies. So thank you again, and I hope to see you back again for more conversations.
Thank you.
Thank you.
Of course. That wraps up today's episode of Beyond the Ledger. A big thank you to Nina Desai and Duwayne Sibley for sharing their insights on how real estate owners can uncover valuable credits, deductions, and incentives, and for breaking down what's new in this evolving space. From Section 179D and 45L to cost segregation and the latest legislative changes, it's clear that proactive tax planning can do more than reduce liability. It can unlock capital for growth and investment. If you found today's conversation helpful, be sure to subscribe to Beyond the Ledger on your favorite podcast platform. For more insights and resources, visit btcpa.net and follow Bennett Thrasher on LinkedIn for the latest thought leadership on tax strategy, incentives, and financial transformation. I'm Shardae Layfield. Thanks for listening, and join us for the next conversation on Beyond the Ledger.